Invest Africa, proudly brought to you by KPMG.
Now, world leaders gathered in the generally quiet town of Davos in Switzerland over the past week to reposition the world economic agenda with a particular interest in the emerging markets and their potential for high growth. Joining me in studio is Martyn Davis, CEO of Frontier Advisory, and Anthony Thunstrom, CEO at KPMG. Gentlemen, thank you so much for making the time to join us. Martyn, let's start off with you first. What does a recovery in global markets and global, more the developed world, mean for emerging markets?
Well, I think there's been a dramatic shift in the balance of power, at least shift of interest in the global economy over the last 6 months or so. Clearly, the balance of power shifted away from emerging markets. We were so focused on BRICS in recent years, buoyant growth in emerging markets while stagnant in traditional developed markets. And clearly now it's come back to bite us. Emerging markets on the back burner, very negative sentiment across an array of almost all emerging markets. South Africa clearly being a part of that. And I think going forward now, I think this Davos has been the first Davos since 2007. Davos meeting where we've seen a significant shift in interest back to the, dare I say, the old world rather than the new. Yes, China's still interesting. Yes, we're still praying that China's growth will remain very robust at 7.5% plus. But strip out China, I think the interest is squarely back once again, back on the Americas and the European markets.
If we go back to Davos, Anthony, and we look at a statement that our Minister of Finance, Minister Pravin Gordhan, made on the sidelines of the annual meeting, saying that when we talk about this narrative surrounding emerging markets, we must be careful not to impose a negativity on it. And he says this is just a shift. It's not a tectonic shock that everybody is making it out to be. You know, do you think that he's perhaps downplaying a rather serious situation because of the implications it has on the South African economy?
Nozipho, I think if we look at it from a more Pan-African basis to start with, and I'll come back to South Africa afterwards, to be honest, I'd have to agree with him fully. I do think that you have flavour of the month all the time. And Martyn's 100% right. We've had Africa as part of the BRICS and part of the emerging markets as the flavour of the world's focus for quite some years now. My own view personally, and this is based on interaction with a lot of the global investors that we deal with coming into Africa, is that a couple of years ago there was some skepticism about Africa. They've come into Africa, they've looked at some of the opportunities on the ground, which frankly many of them were not aware of at the time. Even though the US is recovering at the moment and there is a bit of a capital flight out of emerging markets, I honestly believe that the companies that have had exposure to Africa, the funds that have had exposure to Africa, are going to be very reluctant to walk away from those opportunities. I think we might see some short-term volatility around investment interest, but I think Africa's actually moved forward a quantum leap given the focus over the last 2 or 3 years. And personally, I do think that this is something that we'll emerge out of pretty strong.
Let's take a look at a company example, maybe, Martyn. I mean, just a week ago we heard about Sap Miller, improving or increasing their investment into Nigeria. Again, making that statement very clear that a lot of their returns they're seeing from emerging markets. A company like that, in light of the sentiment surrounding emerging markets, what do you think they should do?
I think it was $110 million.
Right.
SAB announced again a third phase investment into Nigeria. Look, the Africa story, the sub-Saharan Africa story, is very simple from a corporate perspective. All it's about is capturing consumers, consolidating markets, and ultimately creating sustainable businesses and ultimately shareholder value. That's what it's about. So whatever happens in the markets for currencies is almost secondary or distant third to this consumer capturing, consumer consolidation story. Almost every enterprise moving into Africa, we hear Fortune 500 companies, JS-listed firms, almost all of these firms that we hear the great success cases, putting in the sizable money into Africa, are all consumer facing of some sort.
Martyn raised a point earlier on, Anthony, and I'm hoping you can take him on. He indirectly questioned the relevance of BRICS in today's climate. Do you see, strip out the China factor, is BRICS still relevant?
Look, I think BRICS, has been a huge amount of debate around BRICS relevance, particularly in contrast to other forums that have existed a lot longer, like the World Economic Forum, and I think it's as good a time as any to unpack that. I do think that BRICS will remain relevant going forward. These are like-minded countries. In many ways, they're countries that are either currently following a similar progression economically and from a developmental state perspective, or ones that in the not too distant past have been down that road before. For me, what's really relevant is not so much the actual meetings themselves and the summits and the gettings together. What's really happened on the back of those is individual businesses have linked up. They've really looked at concrete, razor-sharp focus on opportunities that exist in their respective countries. And I expect that the longevity of the BRICS will really lie around those economic opportunities driven by companies, not just government-to-government talk.
Another grouping, I thought this one was rather sexy when I saw it last week, the delicate duo. And in this sense, they're referring to the Turkish lira and the South African rand. I mean, we're going to have these formations all the time, Martyn, but I want to talk about the interconnectivity of emerging markets. So we see political unrest in Turkey. We see the lira coming down under immense pressure. It has spillover effects not only into South Africa, but into other emerging markets. Talk to us through those dynamics. How does that happen? And what does that mean then when you get into these groupings? Should you rather, try and distance yourself from them?
This is honestly a new one for me, delicate duo. At least it's not doomed duo. That would be a bit more concerning. But we've had BRICS, we've had civets, we've had mints now, which is the Mexicans included there, and the Nigerians. We have Fragile Five. We have the usual G6 or G7, 8, 20, etc. And now delicate duo. I mean, it's a fad, of course, the acronym fad. And what does it really mean end of the day? I think for me it's, there's a geopolitical component to BRICS. There's a geopolitical component to many of these groupings. And of course, I think we should start to move away from that. BRICS has become more of a geopolitical grouping than what it was originally intended as by Goldman Sachs. There's nothing more than an acronym of countries with big demographics, providing perhaps an indicator of future consumer demand in the global economy. That's all it is. Unfortunately, we all be tired of the same brush, perhaps because we all want to get into the same acronyms. Yeah. Acronyms can always go both ways, and I think in our case, it's certainly arguable in SA's case, is that beyond the geopolitics, where is BRICS actually delivering? I think for me, the delivery from an emerging markets perspective, what about peer pressure? The Nigerians are in the mints, and it's an apostrophe S, not a capital S. Why are we not in the mints? Maybe it's because Nigeria is at 7% plus of sizable demographics. We're at 2% with a relatively small demographic, 50 million people. And unfortunately, in this consumer capturing global economy we're living in, capital seeks, again, consolidation of consumers. Big is beautiful. And that's what the whole hypothesis of BRICS is based upon. I disagree with that, but that's what it is. So how do countries start to differentiate themselves? Why are we? Why is Turkey? Why is Mexico? Why is Nigeria? India, Brazil, all grouped in the same category, and we all seem to go down together and all seem to go up together. A simple conclusion from myself is in 2007, there were 114 countries growing at 5% plus. 114. Only 3 countries in the world did not grow that year. Only 3, Fiji, the DRC, and Zimbabwe in 2007. It was easy to perform as a developing economy. Yeah. What we've seen in the last 5 years is similar, where emerging markets almost, led by the likes of BRICS and mints and civets and all these acronyms, have been flavour of the half decade. I think because of potentially distracted capital in traditional world. Now the tightest term the last quarter or so, and now emerging markets, we being amongst the foremost, have to work for our performance. Performance growth does not come naturally, and 2% is inadequate.
2% is inadequate. Now, Anthony, let's look at a report that was released on the sidelines of Davos, this being the PwC report that has been, cited extensively, that South African CEOs are the most pessimistic when it comes to revenue prospects, especially in emerging markets. Again, it's really interesting when you get the voice of those that are considered captains of industry, and this is their particular outlook. Talk to us a little bit about that, and whether you think this is a short-term sentiment that's based just on the current headwinds that we're seeing, or a long-term trend that's likely to ride itself out.
Yeah, Nozipho, I think it's a good question. I think what you have to do, though, and I'm not quite sure how that question was originally posed to them, but again, I spend a lot of time dealing with CEOs of major listed companies in South Africa in particular, and I think you almost have to split that out and unpack it. I think if you ask South African CEOs about their outlook for purely the South African economy, naturally there are reasons to be concerned. You mentioned the very low, and it's been revised a number of times during the last calendar year, the GDP growth in South Africa. And equally, there's been a lot of noise and some real issues around the flexibility of the labour market, the structural reforms that certainly the private sector is crying out for. But then when you talk to the same CEOs based in South Africa around their prospects in either other emerging markets or in the rest of Africa, they actually have a very different outlook. They tend to be much more positive, and that's where they're spending a lot of their time focusing, and understandably so, because a lot of their returns are coming out of those other countries in Africa.
And you've touched on a couple of internal or domestic factors that contribute to the weakness of the South African situation. Martyn, perhaps we can pick up on that, and really to try and get a picture in terms of how much weightage do the domestic factors have as against what's happening globally? The fact that we have labor unrest, the fact that we are growing much slower than the rest of the continent, that our trade, our current account deficit is not worth writing home about. What's more at play here? Is it internal, is it external, or is it a very good balance of both?
Take a total fly here in terms of the weighting of it, which is impacting us great. I think first and foremost it's the external environment. We're in the same basket of emerging market currencies, and you see performance of, as you say, the Turkish lira, the South African rand, the Indian rupee, the Brazilian real, exactly the same situation. We have performed somewhat worse. I think that's the first factor. The second factor is the rand is, I believe, according to GDP, is the world's most highly traded currency. So because of that high volatility, it's impossible, it's literally impossible for our Governor Reserve Bank to actually do anything to counter those very excessive trade in our currency. I think the third factor, and again this is uniquely South African, is we have a very low trust political economy in this country, and we continue to stab ourselves in the foot. We make political statements, political rhetoric, the actions of the unions at times is very unhelpful to what is in a very challenging, trying time. We need to project to the global investor community times of things are stable, things are certain, things are predictable, and ultimately we're pragmatic. I don't think we're projecting all of those, certainly not. And with elections coming up likely in late April, I suspect we're on this for the next sort of 3 to 4 months. We'll have a very similar sort of where we're not causing our problems, of course, but we're certainly not helping them.
Invest Africa, proudly brought to you by KPMG.
So with me, my guest, Martyn Davis, CEO of Frontier Advisory, and Anthony Thunstrom, CEO at KPMG. Gentlemen, welcome back. Anthony, I mean, to a large extent, when you look at the South African case, which we touched on just before we went to break, the question always is, well, at the end of the day, a weak rand means that this is great for our exports. Can South Africa export itself out of the mess that we're currently in as an emerging market?
Nozipho, I think the story of a weak rand being good for exports is probably a little bit misunderstood as well. The kind of the level of fluctuation we've seen in the currency over the last couple of years doesn't support any kind of long-term planning. As a result, production capacity in South Africa is frankly not ramped up to perhaps capitalize on the windfall that we should be enjoying at the moment. We still have issues around sufficient stable power generation, which adds to that problem. So really, I think in theory it provides a great opportunity, but only if it sits at a certain level for an extended period of time, and the economy can actually align itself behind it. That's simply not the outlook that we've seen.
Martyn, I see you shaking your head.
I disagree with it. This it's a nonsensical notion. Anthony says entirely correct, but there's this assumption that somehow cheap currencies drives export performance. That's totally flawed. If that was the case, then we would have found in recent years that the world's most competitive exporting economy would have been Zimbabwe.
Right.
Or how about Argentina in the 80s? And it's not the case at all. Even China, arguably since, well, not arguably, in real terms, for the last 6-7 years, China's currency has appreciated, taking into account real appreciation, but also inflation differentials between the US dollar and RMB, approximately 60%. And yet China remains now an incredible export performer. Currency valuation is a very, very minor issue, if at all, in terms of trade competitiveness.
Well, you said earlier, Martyn, that the governor of the Reserve Bank doesn't have much wriggle room to play with right now, given the situation that South Africa is in.
Yes.
What interventions can the governments of emerging markets make at this particular time when we're seeing currencies free falling to what seems to be a bottomless pit?
Look, I think there's an ideological argument here, there's maybe a pragmatic one. The ideological one is people would say, well, the state needs to intervene, control, manage, and almost a China style. China has been very clever in the last, and very pragmatic, almost like the Singaporeans in the last 2-3 decades, to create a very creative, very unique almost monetary structure that allows it to manage its value of its currency according to it, as the state sees it, its own economic requirements at that particular time. The challenges for a country like South Africa, we're such a marketized economy, so plugged into global forex trades that it's impossible to do that. You can't select reverse gear when you're a marketized economy, unless then you have serious challenges going forward. I think at a more sort of pragmatic level is, and this is, you hear these phrases in Davos this last week a great deal, is emerging markets need to undergo structural reforms. Now what does that mean? It means labor reform, means less bureaucratic red tape, more pro-business environment. I tend to fall into that camp. I think we need to be able to far better manage the economy. Look at the countries. Which countries, the real question to pose is, which countries have elevated themselves by their own bootstraps out of this emerging markets camp, if you will, and are starting to stand on the merits on their own investment cases rather than that of their former peer group. Countries like Singapore, countries like South Korea, arguably, perhaps a couple of others. So I think we need to get to that stage where we almost graduate from the acronyms to a standalone. Arguably, China's already there.
I mean, Anthony, I see you nodding a little bit cautiously when Martyn talks about, lifting ourselves out of our own bootstraps, out of this particular situation. Are structural reforms the answer? And if that is the case, in South Africa, where should our priorities lie?
I think structural reforms are of fundamental importance, particularly around, Martyn mentioned policy reform. I think policy reform is important, but equally it's as much around policy certainty. And I think, if we look at Africa as a whole, it's a small country that punches way above its weight in terms of investment interest at the moment, a country like Rwanda, where they have made substantial strides in reforming any number of policies, but they've also created an atmosphere of certainty. And for a small country of 10-12 million people, the amount of investment interest out of global players who've got lots of other countries to look at is frankly astounding. I think there are two aspects to it, though. I think you can do so much initially through policy reform and policy certainty, but you've actually got to create that platform that the rest of the world recognises what you've done. It goes to making sure that you don't have wild statements being thrown out in political circles, because really the second part of this is really attracting foreign capital into emerging markets and long-term capital as opposed to perhaps opportunistic and trading capital.
And of course, it's understood that Team South Africa went to Davos with the view of selling the National Development Plan to the world as our blueprint that is going to get us out of any perceived impasse that we may be in as an emerging market. Your views on the NDP, is it sufficient? Is it a good plan? Is it the answer?
Nozipho, put this in context, if I may just digress just for a split second. This reminds me, where we are now reminds me, I lived in South Korea in the late 90s during the Asian financial crisis. And it looks very similar. Plunging currencies, relatively slow growth, high unemployment, rising inequality, hot capital, hot money being pulled out rapidly and destabilizing the fiscus of many emerging market countries. That's what happened in Asia in 96, 7, 98, 99. And the countries that came out quickest and recovered and rebounded so quickly were countries like South Korea, countries like Singapore, which cut the costs of the state, were more driven towards productivity, competition, pro-business environment, and even more, surprisingly, almost ironically at times, more open to foreign capital than they were previously, particularly the case of South Korea. Those countries that don't reform, countries like Japan, remain almost momentum economies. My concern is South Africa perhaps will be becoming more and more of a momentum economy, where we're 2%, 2.5%, where we're not doing anything new, we're just moving on previous sort of momentum. I think that's sort of something important for me. On the NDP, of course, it's great, it's pro-business, but again, it's not about, I think we've had a bit of, we talk about acronyms in terms of countries and emerging markets. Maybe we domestically in South Africa have acronym fatigue as well creeping on. We've had a lot of acronyms post-1994. The last thing we want is more acronyms and more policies and more plans. Ultimately, we want an effective, efficient state, a high-trust political economy where business can deal with government, government can approach business in a very constructive fashion, and we can drive growth in this economy. There's no reason why we should not be getting 5-6% even now during these trying times in our country.
I mean, I think to a large extent we spent the better more than half of the show looking at almost the pessimistic side of emerging markets. Anthony, let me come to you. There's always money to be made in one situation or the other. So the emerging markets are slightly under pressure right now. We're not sure whether this is a long-term or short-term trend. How do you make money out of the situation, and where should you go?
I think the important thing is not to get distracted by those short-term fluctuations. If you take a look at Africa as an emerging market, the three mega trends are not going away in our lifetime. It really is around what Martyn spoke about in terms of capturing the consumer base in Africa. That's 1 billion plus people. Any reasonable projection has that doubling to 2 billion odds by 2050. They are a young population, they're urbanizing rapidly, and they basically have an unbelievable appetite for almost any consumer good, from the most basic to the most luxury high-end goods. That's simply not going to change. The appetite for infrastructure, it's either a glass half full or half empty. You could easily turn around and say Africa's infrastructure is nowhere, it hasn't been maintained, it's woefully insufficient. The reality is just the growing pressure of electoral groups is going to push governments increasingly to deliver. It might not be as quick as we'd like to see it, but realistically that's a 10, 20, 30, 40, probably 50-year catch-up plan. If you take a look at any estimate of what we're investing in infrastructure at the moment versus the most conservative estimate of what's required, it's somewhere less than half. And then really around natural resources, I think minerals in South Africa in particular, there's been a lot of talk that we're going to run out of the mineral wealth we have at the moment at some point in time. If you look at it on a pan-African basis where a lot of those high-growth economies sit, that's frankly not going to happen either. They are literally finding new reserves all the time. As you get more cost competitive, there are reserves that you otherwise couldn't mine efficiently. And when you add the oil and gas funds across the continent and increasingly the natural resource focus on Africa, honestly, for the next 50 years, Africa is going to be a player.
Martyn, how are you going to be making money in this current period?
Well, of course, I think there's the market story, the stock market story, there's the growth story, totally different narratives. There's the consumer capturing story we spoke about, Anthony, you reinforced that as well. I think from Africa is there's not much competition in this continent, really. The profit margin is extremely high. I think for me is to invest in who's winning in Africa, bring this closer to home. Is it the Chinese? Is it the other BRICS countries? Is it the traditional players, the Europeans, the British, the Americans? Maybe it's the South Africans. And arguably, almost all the companies I'm seeing which are expanding abroad into the region, what is Africa is after all our own economic hinterland, in the same way that Southeast Asia is China's. Capturing these consumers, creating sustainable, viable businesses and shareholder value. Most of these are J-listed companies. I think for me the opportunity is South Africa should not be seen as a standalone anymore. South African corporates, the imperative to internationalize business, internationalize revenue in US dollars, particularly in this depleted currency value environment, is certainly clear. I think the opportunity is to invest in a well-governed exchange like the JSE for South African companies, blue chips that are building and consolidating businesses in what is a very robust growth region. Yes, it's full of risk.
Yep.
Yes, it's a politically sometimes a mess, but the profits are there undoubtedly, and best do it with good governance structures through South Africa.
Anthony, your final comments on where you think monetary policy should be going in South Africa in light of the almost confusion or instability of emerging markets right now?
To be honest, I think South Africa's policies have been well thought out. I don't really think the last thing I think South Africa needs now is a knee-jerk reaction. I spoke earlier on about the simple importance of policy certainty. I do believe South Africa will ride this out. As Martyn says, we're sitting on the doorstep of the rest of Africa where growth rates can be 7, 8, 9%. There really is a lack of competition as well in a lot of countries across the continent. If you pick your sectors, you pick your countries, you pick your companies in South Africa that have a real exposure, specifically where you want them in Africa into those sectors, I think we're in for at least a good time for the next couple of years.